Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're exploring the UBS Global Investment Returns Yearbook 2025. The Yearbook is the authoritative guide to historical long-run returns. The latest edition was launched this month and is a production once again of UBS Investment Bank and UBS Global Wealth Management's Chief Investment Office in partnership with Professor Paul Marsh and Dr. Mike Staunton of London Business School and Professor Elroy Dimson of the University of Cambridge. This year's piece explores how 125 years of historical data can provide insights for the future. Up for discussion, amongst other themes, were the arresting long-term outperformance of stocks against bonds, bills and inflation, how diversification can manage volatility, and why inflation remains such an important consideration over time. To quote our regular guest on this show, Mark Haefele, CIO at UBS Global Wealth Management, in his introductory remarks, the Global Investment Returns Yearbook once again teaches that a long-term perspective matters and not to underestimate the value of a disciplined investment approach. Well, to unpack some of those key findings from this year's edition, we're once again very fortunate to be joined by Paul Marsh, Professor at London Business School. Professor Marsh, lovely to chat with you once again. And interesting, I guess, to sort of compare notes with our conversation from 12 months ago, the Global Investment Returns Yearbook 2025. And I guess, well, let's zoom out. What does 125 years of history tell us about the future? A nice, easy question for you, Paul, to get started.
Terrific, yeah. The yearbook documents and analyses 125 years of investment returns back to 1900. And its purpose is to use financial history to try and shed some light on today's investment issues and help us better invest for the future. What does it tell us? Well, I guess one of the big things it tells us is that stocks or equities have been the best performing asset class everywhere that we've looked over the last 125 years. And bonds have been the second best performing asset class, and cash has been the worst. And so equities, which are the riskiest, have given the best returns. Bonds, which are of intermediate risk, because we're looking here at long-dated sovereign bonds, have given an intermediate return, and cash has given the lowest return. So the law of risk and return has held. So I think that's probably the biggest finding.
Yeah, and let's just interrogate some of the language, because we talk about long-term and long-run, and obviously this is it's calibrated over an unusually long period of time. And there's a playful sort of note on this at the end of the piece, actually, about the long run taking a long time. And this is instructive, Paul, isn't it? Because, we're 25 years into this millennium and century, which is kind of seems impossible to me in some ways. But what people mean or understand by long-term is in and of itself quite interesting in this context, isn't it?
It is, yes. I mean, a lot of people think that, 10 years is long-term or 20 years is long-term. The problem with that in financial market terms is that asset returns are very volatile, especially equity returns. And if you look over a 20-year period, you can have a very good 20-year period or a really bad 20-year period. And it really doesn't tell you very much about the long run. And so even 125 years, in our opinion, is a bit short. And that's, of course, much longer than most people's horizons, because it's much longer than most people live.
Let's talk about some of the other striking findings, Paul, and I'll try and sort of make some succinct points, but do correct me if I misrepresent anything. Just to talk about the dramatic changes in markets, I think one of the things that's interesting is if you have this kind of time frame, there are whole sectors, right? Industries, disciplines, which were in some cases even, represented the sort of majority of the market at different points, many of which don't even exist at all. Now, I guess that's to be understood because of technological innovation and all that kind of other corollary changes. But it's interesting where, despite those changes, other assumptions we might reasonably have made have proven to stand the test of time.
Yes, absolutely. Today, we have technology dominating in the world and in the US, of course. Go back 125 years, you had railroads dominating, making up 2/3 of the New York Stock Exchange at that time. And railroads, of course, are now a very, very small part of the US stock market, well under 1%. So we've had these huge changes over time. But in a way, stocks are stocks, and people price them in the same sort of way that they did 125 years ago. In other words, they look at their earnings, they look at the potential for dividend growth, and they put a price on them. And they put a price on them that reflects the fact that equities are riskier. And so you get an equity risk premium over time because people price them in a way that expects that equity risk premium. So some things are almost eternal, other things are hugely changing. And if we were to put ourselves 50 years or 100 years forward, we can't even imagine what will be the dominant industries going forward 50 or 70 or 100 years.
And that is interesting because I suppose if we look back through the context of that first kind of broad takeaway you mentioned about the long run outperformance of stocks, of course, that does not mean to say, indeed, the opposite is true, that it's been smooth sailing. And like you said, in 50 years, we won't know. But what we will know is that during that intervening half century, there will have been, in all likelihood, a great deal of volatility. And it is interesting, isn't it, Paul, to compare, because there's a great figure in here that, you know, a single dollar invested in US equities in 1900 would be worth something of the order of, I think, 100,000 today, right? But we have seen astonishingly volatile performance, obviously, early 30s, mid 50s, early 2000s. It's interesting to make those broad brush observations, isn't it?
It is, yes. I mean, we've seen some very, very savage bear markets. In terms of equities, the grandfather of all of them is the Wall Street crash. And in real terms, that is in purchasing power terms, investors lost nearly 4/5 of their money. And it took 15 and a half years for markets to get back to where they were in 1929 after the Wall Street crash. And we've had several other bear markets over time when investors have lost more than half their money in real terms. We've had two of them so far this century, in the last 25 years, in the 21st century to date. So we've had extraordinary volatility, not just in stocks, but also in bonds. People think of bonds as being safe, but actually when you look at bond returns, these are long-dated government bonds. We've had periods where there's been drawdowns exceeding 50 years, where bond returns have fallen 67% from their peak in real terms. So bonds are not safe either. And one of the issues that we've addressed in this year's yearbook is diversification, ways in which you can try to mitigate the worst of these excess periods when markets really fall out of bed.
In your day-to-day work then, it must be so interesting. I know you obviously you work on this with your colleague, with Mike and with Professor Dimson and others, etc., feeding in. Does it change anything about, I don't know, your fundamental approach, I don't know, to finance, the way you teach, the kinds of research you maybe think you were going to switch emphasis into? Because it must be so interesting when you pick out these incredible themes, these threads that run through all of this history. Do they actually change, I don't know, the way you're going to approach your day-to-day even, Paul? I don't know. Tell me.
Yeah, I mean, it does. When we started this 25 years ago, most people in business schools were teaching that the equity risk premium was pretty high, maybe 6% geometric, something of that kind. When I say geometric, I mean annualized return over time. The history just doesn't substantiate that. And furthermore, history was rather kind to equities in our judgment. We've had that wonderful period from 1950 onwards. So we have revised downwards our judgment about what the equity risk premium is. We think it's probably prospectively around 3.5%, which is still pretty good. 3.5% more from stocks than from cash means you would double your money relative to cash in 20 years. But that has big implications for asset allocation. It has big implications for regulators who are deciding for regulated utilities, what prices they can charge and so on. So we have changed what we teach and we've changed what we think about the equity risk premium. We think it's smaller than the textbooks told us. That's just one example, I guess. In terms of my personal approach to investment, it's stressed that diversification really, really does matter. A diversification across stocks, across countries, and across asset classes. So I've certainly become a maximal diversifier when it comes to investment.
Professor Paul Marsh. And that D word, diversification, is indeed one that will crop up with our next guest. So let's hear from him. Kiran Ganesh, Bulletin Regular and Managing Director in the UBS CIO. Kiran, welcome. A delight to talk to you as always. Now, the Yearbook underscores the enduring value of looking back to better look forward, right?
Yes, absolutely, Tom. I think when we are looking at markets, it's often so easy to get caught up in the short term because, of course, things can feel volatile in the short term. It can feel particularly uncertain. But when we can look back over such a long span of history, I think that really helps us put some current issues and current volatility in their proper context. And by looking back on that kind of time span of history, you can really identify what are some of the key trends in financial markets and what issues perhaps in the past have been somewhat more ephemeral.
Were there any particular headlines that stood out this time? A theme that struck me this year was American exceptionalism. Timely analysis, maybe. What jumped out at you, Kiran?
I mean, I think there was certainly some things that pop out. I mean, when you look back at 125 years of history, it's not like things change dramatically from year to year, but I think a few things did stand out. I think one big headline from the report is the fact that equities outperformed bonds in every country over that time span, and bonds outperformed bills in every country but one over that time span. So a really strong endorsement of the laws of risk and return, and the idea that if you want to create wealth over the longer term, you do need to take some short-term risks in order to do that. So I think that was certainly one very big headline. And then, of course, amid some of the concerns currently around US concentration risk in global markets and US concentration risk in individual stocks. I mean, I think the fact that the US is actually still one of the less concentrated markets globally, and the fact that for most investors in most countries, diversifying globally, including into the US, would have delivered an improvement in risk return and an improvement in performance, I think is something that's quite important to bear in mind when investors are perhaps considering their US allocations and perhaps being concerned about their US allocations in the near term. Longer term, it has made a lot of sense to diversify toward the US and to diversify globally.
Talk to us a little bit next up, Kiran, about 20th versus 21st century returns.
Yeah, so if we compare the 20th century and the 21st, it's actually a little bit counterintuitive that although markets seem to have been quite strong in the 21st century, perhaps because we're looking back at the very recent history, performance of equity markets has actually been a bit poorer over the balance of the 21st century than it was in the 20th century. And of course, part of that is because we have had perhaps an unusually high number of bear markets in just 25 years. Of course, we had the dot-coms crash right at the beginning of that period, then the financial crisis, then in different parts of the world, the Eurozone crisis also had a negative impact. And we've had periods of volatility related to China and to rising interest rates. And then, of course, the COVID pandemic as well. So, a number of bear markets in quite a short space of time has meant that the 21st century actually hasn't delivered as strong returns overall as what we saw in the 20th century. At the same time, it's of course, with these kind of comparisons, your starting point does make a big difference. And the fact that we were really at the peak of the dot-com bubble in the year 2000 certainly depresses returns for the 21st century when we look back. So I think overall message has been a bit lower so far, but there's no reason, we think, for us to expect very materially different outcomes going forward than we saw over that longer term.
Look, Kiran, we were hearing from Professor Marsh a moment ago about the D word, diversification. Let's turn to that next. The Yearbook shows us how diversification helps to manage volatility over time, right?
Yeah, I mean, diversification really important in a number of contexts. So when we look at the Yearbook and you see some really strong outperformance for stocks relative to bonds and bonds relative to cash, it makes investing seem really easy. It makes you think, well, why don't we just put all of our money in stocks and leave it there? Now, of course, we know that the reality is that for most investors, dealing with the short-term volatility is more challenging, and the drawdowns in equities are of concern, and very rightly so if investors are withdrawing from their portfolios in particular. So diversifying across asset classes, a mix of equities and bonds, is a great way to continue to earn decent returns, but also reduce the scale of drawdowns. There's some great figures in the report that show the extent to which 60/40 portfolios can help reduce portfolio drawdown. So that diversification, really important to allow investors to manage volatility. But diversification also really important in order to earn returns. So if we look within equities, for example, if investors are concentrated in individual countries, there's a greater risk that they're missing out on some of the few stocks globally that are generating performance. So global diversification often thought of as a way of reducing risk, but in equities, diversifying is actually the only way that you can really ensure that you earn some of those attractive returns over time. If you have a concentrated portfolio, then you might be missing out on some of the companies that are really going to create a lot of value over the balance of the 21st century.
And Kiran, do emerging markets offer better prospects in this regard for developed market investors?
Yeah, so emerging markets have had a challenging ride, and I think one of the great things that the study does is actually go back over time and have a look at what might have been considered an emerging market previously, because of course the kinds of markets that today we think are emerging markets might be different if we go back. Of course, there was a time when even the US was an emerging market, or when Japan was an emerging market, and of course these are now very much considered developed countries. When we look back at the full balance of history, a lot of the EM versus DM performance really comes down to some of the very weak EM performance that we saw during specific periods. So if you look over the majority of time periods, EM and DM have actually delivered quite comparable performance. The challenge you've had in emerging markets is just that there have been some times when they have materially underperformed due, for example, to wars or very high rates of inflation or depressions. So we think that going forward, EM plays an important role in a portfolio. It is really a part of that diversification process. And though when we look back at the full history, developed markets have done better than EM.
Kiran, Ganesh. And finally, let's check in with Tim Ramskill. Tim's the head of Global Product Management within the Investment Bank and Research at UBS. Tim, welcome back to the show. What jumped out at you, Tim, one thing that I talked very briefly to Kiran about was this idea of American exceptionalism. Obviously, that's very timely. Was that one of the standouts? Tell me a little bit about the themes that kind of grabbed your attention this year in particular.
Well, I think that's a great place to start for a couple of reasons. One, it has clearly been a topic very high within the kind of market context and narrative over recent times. But then also, very interestingly, the professors point out that when they first undertook the work at the dawn of this century/millennium, they were there making exactly the same observations about the 20th century having been a period where US market performance had been just that. It had been exceptional. And perhaps at that juncture, they may have themselves been questioning whether that could really truly continue. And yet here we are a further quarter of a century further on. And to some degree, that narrative has remained sort of unblemished, and at least until we get to sort of almost like recent days. But again, recognizing that short-term, long-term dynamics are very different. I think beyond that then led very nicely into the special chapter within the yearbook. So each and every year, the professors have focused in on a different area. When we were sitting down deciding how to tackle that component, it felt really sort of very apt to really dig deep into considerations around diversification. And I think, as the authors describe, if diversifications, which I think most investors would recognise is something we're aspiring to achieve, then the opposite of diversification is concentration, which again is a feature that we have seen within the marketplace very much in recent times. Whether that's again going back to the topic of American exceptionalism and the proportion of the global investable universe that is accounted for by the US market, approaching but not quite sort of 2/3 of global equity value, but then also within the US market, where again the level of concentration, the extent to which the largest stocks dominate the US market, is at a level now that hasn't been seen for in excess of 90 years. So, we are sort of, again, tackling kind of long-term considerations at a point where some of the near-term characteristics do, by historic measures, look relatively extreme.
Yeah, let's interrogate that in a bit more detail, because both Paul Marsh and Kiran spoke already about diversification, how it can help manage volatility. There's lots of evidence of that over time. One thing that I thought was interesting was that if we think about investors within developed markets, EMs continue to offer better prospects diversification-wise than developed markets. Again, that's not a sort of radical but learning, but it is interesting that maybe that's an instinct people might have or something that they habitually do. It's definitely underscored by the body of the research over time, right?
Yeah, that's right. I mean, I think perhaps an interesting place to start with this conversation around geographical considerations of diversification is perhaps with the observation that, again, going back to the strength of US performance, if you'd been a domestic US investor, you would have ultimately been worse off from diversifying across the rest of the globe. But then when we start to look at, individual other geographies and markets and the considerations that can be gained and the benefits from a diversification perspective that can be gained by broadening out the sort of suite of countries into which one is invested, including emerging markets, then that does start to become a positive feature. But as I say, the fact that US investors would have been better placed, sort of staying closer to home, it's an interesting one.
Let me ask you about the I word, Tim, whilst you're here. Talk to us about inflation. Obviously, it's always an important consideration, but it's important, really, short-term, medium-term, long-term. And again, it's looking through the prism with all of this history, you see how important it is when considering long-term returns. Just give us a quick overview of, again, what does the data and the report tell us about the role of inflation in this space?
I think the big headline, and again, this is something that's featured in many previous editions of the yearbook, so isn't new per se, but I'd still say it runs counter to many perceptions one tends to sort of come up against, that equities are a good hedge for inflation. That's the perception. The way that the professors tackle the subject demonstrates very clearly that that's not really the case. So periods of inflation are not necessarily periods of high inflation, and not necessarily met with superior periods of equity performance. Now, what you do see over the longer term, which might explain why there is that perception, what you tend to see over the longer term is that because you benefit from the equity risk premium in being invested in equities tend to perform better than inflation over time. But then in the short term, some of those characteristics I've just outlined might play a bigger role. Clearly quite closely related to inflation is the mechanism for dealing with it, normally central bank interest rates. And I know when we spoke a year ago off the back of the 2024 edition of the yearbook, there was again much focus and much anticipation of pretty broad central bank interest rate cuts being at that point relatively imminent. Now, clearly what we've seen over the course of the last 12 months is a little bit more divergence, particularly between the Fed and the ECB. And so, again, we'll work in the yearbook looking at the dynamics around equity performance linked to the interest rate cycle. Again, I think is remains, once again, topical and entirely worthy of being revisited.
A last brief thought from you, Tim, on, I guess, the enduring value of this kind of long-term research and the understanding it facilitates. Tell me about that.
You often see patterns recur in terms of market characteristics, and the yearbook provides that wealth of information, enabling people through so many different lenses, whether, again, it's considering rate cycles, inflation characteristics, risk return characteristics across different asset classes. It enables people to sort of build that extraordinary foundation of knowledge against which I think they can ultimately be better prepared to navigate the landscape. There have been a number of investors over the years and to some degree, some of the press and journalistic coverage that we see that references that, nobody who hopes and enters the marketplace wishing to be seen as a credible participant should avoid kind of reading this. You bring this knowledge to bear, you put it in your baseline, you kind of, never kind of allow yourself to sort of deviate too far from that long-term understanding, whilst recognizing that, there's so many other drivers at play that, people have to be very, very focused on in order to sort of continue to be successful over shorter time horizons. So I think it provides fantastic balance to the body of work that we at UBS produce that very often is clearly dealing with much shorter timelines, and rightly so. But I think in combination, you end up in a fantastic spot.
Yeah, absolutely. I can't remember. I think it's Mark Hafley said in his introduction, isn't it, in the piece? I can't remember now. I haven't got the report in front of me, but is that Wordsworth quote about, learning from the past and profit in the present? That's it, right, Tim? That's what it's all about.
Exactly. The yearbook is perhaps, the counterpoint to the argument that runs along the lines of this time it's different. The yearbook would suggest that that's probably unlikely to be the case. Just as I say, kind of recalibrating and appraising oneself of those long-term considerations and characteristics, I think is a worthwhile exercise from time to time.
Tim Ramskill. And that brings us to the end of this edition of The Bulletin with UBS on Monocle Radio. You can listen again and explore more at monocle.com. You can also follow this show wherever you get your podcasts. And don't forget to discover more and find out how UBS can help you at ubs.com. While you're there, search Global Investment Returns Yearbook 2025 for more insight, analysis and resources. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.